This podcast is for informational purposes only and does not constitute investment, legal, or tax advice. The views expressed by the host and guests are their own. Listeners should consult professional advisors before making any investment decisions.
Welcome to Fixed and Floating, the credit podcast. I'm Josef Pschorn, and in each episode we explore the forces shaping credit markets. Today, I'm joined by Jared Muroff, who's been following First Brands closely. Jared, great to have you on Fixed and Floating. Before we dive in, could you give listeners a quick sense of your background and your work at Octus?
Sure. Thanks, Joseph, and thank you for having me. So my name's Jared Muroff, and I'm the head of special situations here at Octus. I work on the Americas side, so I'm working in U.S. companies. We're public facing, so we're working on public companies or information on private names that's been made public, whether through our desk or our own. I've been here about 2.5 years helping guide our coverage. Prior to that, I spent almost 20 years or so on the buy side in distress, doing distress and special situations, working on DIPs, credit agreements, lending into interesting and various situations, as well as a heavy focus on trade claims.
How did you first become aware of the First Brand story? Was there a moment when you realized this one was different?
So we first became aware over the summer when they were trying to do a refinancing transaction. I think it was in July. They launched it late July. And then in early August, it turned out that they were unable to do that. And so that was the first time it really came on my radar. And I would say one of the interesting things about it was not just that they were unable to get the financing done at a time when most companies were able to, but that it was the rare situation where it wasn't really a sponsor-led company. So that's something that's very interesting about First Brands, and I'm sure we'll discuss as we move forward. But First Brands was at the time run by a single gentleman who was the owner, Patrick James. And so you had this situation where it was not a sponsor-led company, and so was having trouble raising financing up, was looking for, I think, $5.5 billion or so in its financing, and was unable to do that.
For those who haven't followed it that closely, why has this case captured so much attention in the distress market, but also in the overall public space?
Yeah, so I think there are a couple of things going on that are driving it. Again, having a non-sponsor led company, I think, makes it interesting. As well, there have been some allegations of fraud that are out there. You have a situation where a company was reporting to the street that it had about $6 billion in liabilities. And it turns out that if you count the off-balance sheet liabilities, which you should, it was more like $11 billion. And so as that became clearer and clearer, that was the situation, I think it's captured Wall Street's attention. You've heard comments coming out from folks as varied as Jamie Dimon and Howard Marks in terms of cockroaches in the private credit. And so this is an example that folks are using. There are allegations of double pledging of inventory. So I think it's captured the attention of Wall Street because of those allegations of fraud and concerns about it being a real business or less than a real business at a time when the market is ripe for looking for that sorts of thing as the credit cycle gets older, it becomes more aged, and we're getting more of this move into private credit as it's taking over the market. So I think it's on a couple of different axes that this has become an interesting case for Wall Street writ large.
Just for context, what exactly does First Brands do, and where does it fit in the broader auto parts ecosystem?
So First Brands, is a roll-up. Patrick James was executing a roll-up strategy where First Brands was buying various suppliers of automotive parts for the aftermarket. So think about wiper blades or air filters or brake pads, things that the home repair enthusiast would use to fix up their car. You need windshield wipers. Instead of going to your manufacturer and paying through the nose, you might look to go to something like an AutoZone or an O'Reilly Auto Parts, a part supply store where you can buy that yourself and install it yourself. And so First Brands was the seller of those into the retail environment. So they had a variety of brands. I think it was well north of 20 different brands. Fram auto filters are one of the big ones. There's brake pads, all these different auto parts that they were able to supply into that part of the ecosystem. So really going into the auto parts retailers, O'Reilly, AutoZone.
So it's fair to say that it's mostly supplying to the retail side.
I think it is absolutely fair to say it is supplying to the retail side. Yes.
Okay. As you just mentioned, they grew very fast through acquisitions, very similar to a classic private equity roll-up. How was the founder being able to pull that off despite having very limited industry credentials?
So that's an interesting question. I think part of it is he was able to get the financing to do it, and he was able to roll it up in that regard. I think he'd historically hired in some folks, or some folks had come in through the integration of other entities that had helped him do that. But I do think Wall Street tends to like a roll up. I think lenders do like folks who continue, or companies that continue to borrow. The investment banks like that flow as well, and so there's a lot of things that augur for them to want to do business with someone like Patrick James and First Brands. He was a fee generator for years and years, and so that helped him to pursue that strategy to be able to buy companies up. I think there were mid-single digit multiples where he was able to roll that up. It remains to be seen. As I said, we haven't really seen the financials. Frankly, no one has, because there's some real question about them. But it remains to be seen whether he was applying the general sort of roll-up strategy and benefiting from any sort of economies of scale, or this was simply a game of building as big a company as he could to take out as much money as he could.
I mean, the margins looked generally very healthy, even better than peers. As you just said, it made the company Wall Street darling. So what was driving that? Was it more like on the operational strength side, or more towards financial engineering?
Again, hard to say specifically, but I would lean towards the latter, financial engineering. I do think some of the margins that were being shown to the street were not counting specific things that should have been counted. One thing we will likely get into, one of the interesting things about this industry is that the auto parts are sold into the retailers with a very, very long credit cycle. Traditionally, we're used to seeing net plus 60, so 60 days when bills need to be paid, maybe 90 days when bills need to be paid. A lot of these, payment on them wasn't made for 365 to 540 days. That's a year to a year and a half. That is very long to have that inventory sitting at your on the retail shelves and not being paid for it. There are reasons that exists and that call into question this business, which I'm sure we'll get into. But there is a cost associated with doing that, just the time value of money. But as well, there was an external cost to it because First Brands was financing those receivables and paying a rate on those. And that doesn't appear to be incorporated into the margins in the way it probably should have been. So they were likely showing margins that were in excess of what they were actually earning.
Does this hold true for every automotive supplier which sells mostly into retail?
It does appear that if you look at the retailers, the auto retailers, so again, AutoZone or O'Reilly, and you go to their filings, they do indicate that their payable cycle is this long, a year and a half. So it does seem like that is the case in the industry. It's not clear to me why that is, but it does seem that First Brands was doing what its peers were doing in that regard. So it's not that they were providing terms that were out of market. It's just that the market terms had become so onerous in that way.
Okay, understood. Why are generally auto parts companies such heavy users of working capital financing?
So I think that's a function of the business itself. And that's where we come into a question of whether this business is a broken business model or not. Yeah. Because of, as I said before, every store needs to have pretty much everything on its shelves. And the number of SKUs is enormous because the number of makes and models from each of the automakers, and you need to, it changes when they change the make and model. May change every year the windshield wiper blades that are used, and there's not as much standardization even across individual automakers. Forget about the industry wide. You have a situation where there's a lot of inventory that needs to sit on the books of the auto retailers. Why it was decided and how it was decided that this would be the problem of the auto parts manufacturers, I can't speak to. I don't know how that happened, but it has apparently been the case. It does seem that and this is why there's a concern about this business maybe being broken. It does seem, at least in the First Brands case, that this was sort of an internalized cost that was never paid for by anybody, and now is being paid for by all of the lenders who have less than par paper. They were shouldering that. They didn't think they were, but they were shouldering that. So it may be a situation that pricing, in order for those auto suppliers, those auto parts retailers to be competitive, they need to keep their price below the OEMs. But it may be that they're not able to do that once you externalize the costs of the financing and all the supply chain and are actually getting a better read of it. That's a little far afield for us to say right now. I don't cover those names. I'm not as familiar with them on a broader basis, but it does call into question whether or not First Brands is a broken model. Can it come out of bankruptcy once it starts to account for these costs of financing within its margins? Does it still look as attractive as it does, or is it able to raise its prices enough to make it look attractive? That's an open question.
When First Brands sells a product to O'Reilly, the cash will ultimately be transferred from O'Reilly to First Brands once O'Reilly has sold the product. But First Brands finances this amount of time through working capital financing. Is that how we can think about it?
Yeah, I'm not sure if O'Reilly is waiting until it's sold the inventory to do that. I think they just have extended terms of 365 to 540 days.
Okay.
So it's not a consignment agreement. So there's not a consignment. It's not being held for First Brands. First Brands doesn't get to pull that inventory back. That inventory has been sold to O'Reilly. It just hasn't been paid for. So on the O'Reilly side, that would become that once that inventory is shipped to O'Reilly, once O'Reilly receives it, regardless of the fact they haven't paid for it, it would become collateral for O'Reilly's lenders who have a claim on the inventory. So it would belong to them. One of the things that one of our analysts, Justin Spuma, had suggested might have been a precipitating factor for First Brands is that there was a downgrade in the space that may have raised some of the cost of the some of the cost of the accounts receivable financing, because again, you're taking a counterparty risk when you're providing that financing. If that counterparty has a lesser credit than it did a day ago, you're going to charge more. So that may have been one of the precipitating events. But again, it's hard to disaggregate all of that because there was so much going on at the time, and then it kind of just tumbled into bankruptcy.
Okay, so what you are saying is that once the retailer gets downgraded, that has also a ripple effect on First Brands, which then faces a higher cost of financing, given that its counterparty is now a worse credit rating.
That's right. And instead of thinking of it as a higher cost of financing, which it is, to be clear, you're right.
Yeah.
But think of it as a lower realization on its sales. It's going to book sales. It's going to book sales at 100 cents. But if it costs 6% to finance it, it's going to get 94 cents. If it costs 8 cents to finance it, 8% to finance it, it's going to get 92 cents back. So you can see how levered they are to the credit risk of their customers, even as the customers are still performing on their obligations.
And all that was not reflected in their EBITDA numbers?
Yeah, I don't believe it was in the adjusted EBITDA. I've only seen some of the, again, I'm on the public side, so I haven't seen all of the filings. I've seen some of the lender presentations. The one I've seen did not do it had some of this costs in there. It did not have all of them. It does not seem, it was a little bit difficult to disaggregate that, but I can't speak to what they were showing on a quarterly basis to their lenders.
Understood. Let's dive into the most important thing, I would say, the hidden leverage story, the working capital mechanics. So the working capital financing at First Brands consists of multiple layers of factoring, reverse factoring, and inventory. Can you break down how this structure actually worked and why it became so central to the company's balance sheet?
Sure. So one thing to keep in mind as you think about this industry, and this is, I think, what underlay all of this, is, as I said, there is a large cash conversion cycle in terms of sales to cash receivables year to year and a half. Part of that, I think, is a function of what they are selling. If you think about it, there's going to be a lot of stock keeping units or SKUs in this product. You're going to need windshield wiper blades for every make and model of every type of car, and they change those models every couple of years. So if you're an O'Reilly or an AutoZone, and someone comes in and says, I need an oil filter for my 2020 Audi A4, you're going to need to have that on your shelves in every one of your stores, because you don't want that customer walking out, going to Amazon. That you're going to need that oil filter for every Audi that was made between 2000 to 2025 for every one of their models. And that's, as I said, going to change. And now think about that across all of the automakers and all of the different models that they have. So it's a lot of inventory units that you're going to need to keep, and they're going to stay on the shelves for quite some time. With this in mind, I think it's important to keep that in mind as we look at how First Brands was financing its business. So one thing I touched on is they were doing invoice financing or accounts receivable financing, and there are two ways to do that, largely speaking, wherein they would make a sale to a customer and they would have an invoice to that customer that would stay out between a year and a half. They could factor that invoice, or basically sell that invoice to another financial player who would buy that invoice and then collect on it at the time, knowing that collections would be in 365 or 540 days. And they indicated in their first day affidavit that this financing had a cost of about 6%. I think it was either in the first day affidavit or in some previous presentations we were able to pull, had a cost of about 6% that they were charging on this. There are differences in this type of financing. There's accounts receivable financing where the buyer is responsible for collections. There's also accounts receivable financing where the seller of the equipment that is subject to the invoice is collecting and then giving those proceeds to the financier. So there's two ways of doing that. They also speak a lot about non-recourse, the non-recourse nature of these financings.
What is exactly non-recourse, or how would you define in this case recourse and non-recourse?
Pure non-recourse financing would mean that once that invoice was sold to a financial player, that financial player is taking the full risk of collections. So if you're taking the credit risk on the other side of the transaction, if they're not able to pay that invoice, that becomes the problem of the person who bought that invoice. Well, that's when people are talking about recourse financing, that's what they mean. Do you have recourse to the original seller, in this case, First Brands, if the invoice goes bad? Because you're taking, when you financing those receivables, you are taking credit risk on the counterparty side. So that's the accounts receivable financing. At the same time, they were doing something called reverse factoring, which is really just receivable financing on the other side, wherein First Brands would owe their suppliers money, and they would try to extend those terms out, and then would provide those vendors with financing, with the financing connection, so that those vendors could get paid today, and then First Brands would pay off those financiers in a year and a half, whenever they could. So that's the second type of off-balance sheet financing they did. The third type of off-balance sheet financing, and this is where we've seen more of the issues arise, is this inventory financing. So in this, it's important to understand that First Brands has sort of two companies that are working in parallel to one another. There are the First Brands debtors, and then there are the SPV debtors, as they're referred to, a number of them, names like Carnaby, the Carnaby debtors, but they're the SPVs that First Brands set up to allow it to do these types of inventory financing transactions. And what would happen in these transactions, largely speaking, generally is First Brands would have inventory. It would sell that inventory to the SPV vehicles. The SPVs would now hold that inventory and borrow against it from financial parties who would have a claim on that inventory. The money would then go to First Brands from the SPV vehicle. So now First Brands has raised financing. And at such time as they needed the inventory, First Brands needed the inventory and was able to buy it back, they would, or because they had sold it, they would buy it back from the SPV entities at a spread, at a margin that would allow the SPV entities to pay off their financing. At which point, then they would do it again. It's a circular thing wherein First Brands is continually going to draw on these inventory financing.
Jared, could you walk us through the key pillars of financing, factoring, reverse factoring, and inventory financing through SPVs, and how did they interact?
Sure, happily. So as you can see here, here's an exhibit we've pulled together at Octus in terms of First Brands. And what we're looking at here over on the right-hand side, you can see we have the cap table or capitalization as of the second quarter of 25, the June 30 numbers, and then at the filing. And so what you can see here, the second quarter of 25 is built based on what they were reporting out to their investors. These are not the audited financials, but what was shared in some presentations. Here you can see they were sitting on about 800 million in cash, so to get you about 6.1 of total debt. However, we then get into the sort of off-balance sheet debt that we've been talking about. So there's a number of other other amounts that are here. These are the inventory financings. These are the SPV debts, Aquim, Carvel, Evolution, and Onset Financial. You have the factoring and the reverse factoring. The factoring includes Raystone is a factor. There's some that was done by Lucadia as well through Jefferies that was done on the factoring side. There was also the Norinskin, I think there was the Japanese banks, Sume as well, I think was involved in that factoring as well. The big one here, the $1.9 billion of Onset Financial, that is a lease, that is a inventory lease. There is some discussion by the debtors that they're going to look to recharacterize that as a true sale, as a financing, likely to be the subject of a great deal of negotiation going forward, I would imagine, because of just the face amount of that and the potential that other creditors need to be aware of, that these claims, this 2.4 billion of claims here that are sort of the SPV debt, could conceivably come into play in terms of recoveries for everyone's debt, especially as we see more allegations being made of double pledging of collateral, as well as collateral being moved away from the SPVs into First Brands for no value provided. And that's where we've seen some of the issues arise, in that some of these lenders have claimed that in fact, the debtors themselves claim that some of this inventory was double pledged, but these lenders are claiming that inventory was moved out of the SPV vehicles onto First Brands books, and they did not receive anything. And then First Brands sold that inventory for the benefit of its other lenders, its First Brands specific lenders. And that's where you wind up with some of these issues that are coming to the fore now, actually this week, with some of these filings in regards to what's going to happen with the DIP and what's going to happen going forward. And it's these inventory financings which really add to the books, how much debt is due from the off-balance sheet side. The inventory financings, these are very large numbers. Onset Financial had a inventory lease agreement, which is a little bit strange, but I think that's $1.9 billion. Evolution Partners had a couple $100 million. There were a couple other creditors, Aquim as well, who had a couple of $100 million in these inventory financing vehicles where they were financing the inventory, but it wasn't on First Brands. It was on the SPV side, all of which were run by Patrick James, to be clear. These are sister companies, or these are similar corporate structures that run alongside one another. The issue was that the First Brands creditors did not know what was going on at the SPV side. And there's been some allegations about that regarding the auditor and how that all works. Certainly is going to play out through the bankruptcy case.
So what you're just saying is that even though the financing of inventory happened on an SPV, the SPV didn't really held all the inventory it should held. Is that correct?
I think it's important to understand that these financings involved title but not custody largely. Mm-hmm. So as the SPVs owned the inventory, and that's true, mm-hmm. but inventory that they owned and inventory that First Brands owned and inventory that someone else owned likely were all on the same shelves in the same warehouses. So it becomes a due diligence issue, and it becomes, you would imagine, an administrative nightmare of sorts. So because title is moving but custody is not, don't think of these inventory financings. And there's a couple of diagrams that the debtors have provided, which make it seem as if inventory is moving from one place to another, and that does not seem to be the case. In fact, these financings were paperwork more than, so it was title that was moved but not custody. And once that happens, you're going to run into, you can imagine, you're going to run into issues with just keeping it all straight, especially when you're thinking about all the boxes of brake pads that might be on a shelf. And how do you, and when you're selling them and you're moving them around, how do you manage that? How do you maintain that? Can be very, very difficult to do. And it seems like that's the case because they've indicated that some of this inventory was double pledged.
Could you explain what the difference between title and custody is?
Sure. So custody is, 9/10 of the law, as they say. That means they have it. They hold it. So if we're in this situation, you could see if Onset Financial, as an example, had a chain of warehouses where they could hold on to the goods that they bought from First Brands. So First Brands would sell it to Onset, and then Onset would keep it in their inventory in their warehouses.
In their own warehouse.
In their own warehouses, in Onset's warehouses. They would have custody.
Yeah.
They hold it. Having title is a legal consideration. So you have a form that says, this is I own the title to this, but it's not where you are. It's not, you don't own the building that it's in or where it's being stored. So you own it. It's your goods. They're just not within. You just don't hold them. You just don't have custody of them.
Understood. And that's exactly where the commingling of collateral happened between the ABL facility and the SPV structures, I guess.
Yeah. So one thing to keep in mind that folks should understand is so if you have an ABL or you have an ABL lender or any lender who's got a first lien, and generally it's ABL we're talking about, but here it could be the term loan. The ABL has priority collateral on the inventory, so that's what we're talking about. But in any situation, I'm not talking about First Brands, I'm talking about any situation, any goods that are shipped to the debtor or have been shipped to the debtor that are sitting on the debtor's shelves or sitting on the debtor's warehouse or wherever they may be, as soon as they enter the debtor's property, regardless of whether or not they've been paid for, are the property of the debtor, and therefore are going to be collateral for the lenders who have a first lien on inventory. So you could see a situation here where the issue with these goods was they did not have title on them. First Brands did not have title on them, even though they had custody on them. But it was not was unlikely made abundantly clear to enough people to understand which inventory was which. We don't know how the systems were working. But you could see a situation where they're all in one place and you have title as held by several different folks, how it would be easy to commingle that inventory. And so the ABL lenders would think they had a lien on something. Aquim or Evolution as inventory lenders would think they had a lien on something, and the company just sold it and did something with the proceeds. And then it becomes a real accounting problem, because to trace all of that, and again, you're talking about, we may be talking about, boxes that, were worth a couple $1,000s of goods that are being shipped. So these may not be large amounts that we're talking about. So you're probably talking about a large amount of small transactions to keep track of whose inventory is what and what happened with it and how it was dissipated.
Yeah, as you just mentioned, I think there are some facilities which charged over 1,000 bips over SOFR, which is around triple what typical asset-backed financing should cost. Would you say that lenders mispriced risk, or was the company overpaying to keep liquidity flowing?
So I don't think nobody mispriced if they mispriced the risk, it was too low. They weren't charging enough. I think the lenders I think the term lenders and the initial lenders into the company that was clearly mispriced too low to the downside, but they didn't know about the other off-balance sheet financing that was involved. So, and in terms of the inventory lenders, I think they saw their opportunity. They seized it when they could. They're, able to make a return. Obviously, First Brands was agreeing to these egregious terms, or what may be egregious terms, and needed the capital. It's clearly a sign. And I would imagine that those folks who do that understand that that's what they're dealing with. In any situation where your borrower is willing to take 1,000 points over, it has to be an immediate question is, okay, things aren't good here. They're willing to take 1,000 points over. How am I the cheapest capital? And that's always an open question. I do think there is a general consensus in the way folks look at doing business, where the default setting is that the person I'm dealing with on the other side, is going to drive a very hard bargain, but is going to be dealing with me in good faith. I think that underlies everything we do in credit, everything we do in investing. And I think for the most part, most people, 99.9% of people are like that and are dealing with you in good faith. Again, you might not agree; they're going to drive a hard bargain, but they are dealing in good faith. Then every once in a while, something pops up where someone who's not dealing in good faith is able to take advantage of that system because everyone else is assuming they are, so they're able to hide these off-balance sheet liabilities when they shouldn't have. And in the case of other situations, other frauds, we've seen Ponzi schemes, things of that nature. Most people, when faced with that, cannot imagine being able to sleep at night knowing they have these risks that are outstanding. Not everyone feels that way, and the folks who don't feel that way are able to take advantage maybe of others who do. And so, certainly risk was mispriced just based on where things are trading right now, and the fact that the inventory lenders are have to fight now for their standing within the bankruptcy case.
When did it become clear that First Brands was running out of cash? What was the actual breaking point?
Sure. I'm going to share another slide here that kind of lays it out. This is the price on the term loan over time. And you can see here's where we reported they paused on it. This is where they announced discussions on it. And you can see it held up pretty well. And then as we got into September, I think there were some concerns about tariffs, some concerns about other items. But there started to be discussions that they were talking with folks over at Weil and Lazard, and then that's really what caused it to break. They entered bankruptcy with about $18 million in cash. And that was a June 30 number. But from the time they failed to get the refinancing done through to the bankruptcy, they were burning cash quite considerably. Not entirely clear what was going wrong. And we have seen weakness in the auto markets and the afterparts market, generally from the consumer. So I'm sure that was hitting them. But they may have also seen some issues amongst their lenders and their supply chain financiers. I think some of them started to pull back from it, had some concerns that were being reflected. I think at the time there was also the onset stuff, the indications that collateral and money was going missing. That all fed in to one another to bring it to where we are today.
Once a company like this hits the wall, what does Chapter 11 looks like in practice?
So I think the important thing to keep in mind with a Chapter 11 is that, and this is one of the most important things about a Chapter 11, is that there's a stay. There's a judicial stay. Mm-hmm. So what that means is when a company enters into bankruptcy, it gives a forum for everybody and anybody who believes they're owed money or believes they're owed anything to come. That you have to go to that bankruptcy court. It brings everyone into one place. And so that's the benefit of the Chapter 11. It basically calls a halt to all of this litigation, calls a halt to that may be in various places, calls a halt to people who are saying, you owe me this, you owe me that, you owe me this. It brings it into a single forum, stops things on a dime, basically, and creates now a new company that is the post-petition debtors. We've also seen Patrick James step aside. The lenders provided, the term lenders provided a dip of $1.1 billion in new money, which I should mention the dip budget shows them running out of money again at the end of the year. So it seems absent a dramatic turn in events, they might need to raise more money. But it's really that stay that so now everything's in bankruptcy. We have a single forum to deal with all of these issues across all of these creditors and all these different creditor bodies. It's one place for everybody to go to argue about this and have one forum for it. And so that's really the benefit of the Chapter 11. So now we're going to give the company a fresh start, and everyone's going to all of their claims are going to be against the pre-petition debtors, and ultimately the goal is to get this thing out of bankruptcy as a new company, leaving behind hopefully any fights there might be, any litigation there might be, leave that behind and move forward with a fresh start. They cannot do that, though, I don't think, until they figure out some of these base issues as to who's going to own it, who has claims against this entity as we go forward.
Can you explain what a DIP is?
Sure. So a DIP, the DIP stands for debtor in possession. When a company goes bankrupt, the company itself becomes the debtor in possession of its assets. So it is a different legal entity than the entity that entered bankruptcy because, again, bankruptcy gives you the automatic stay and creates sort of a stake in the ground Everything before that is a different company. We're going to deal with that pre-petition. And now we have a new debtor in possession of these assets. As a debtor in possession, they, in this instance, and often what happens is they need capital, they need liquidity. They filed for bankruptcy for a reason. Often it is liquidity. So debtor in possession financing is done usually on a priming basis. The creditors agree to, the 1L creditors agree to allow money come in ahead of them on a super priority administrative basis. So that's up at the top of the stack. New money comes in. In this instance, the term lenders put together a group. There was an ad hoc group of term lenders who agreed to backstop a $1.1 billion dip. That $1.1 billion of new money comes in. As well, each of the lenders that provide that new money gets to take some amount of their existing term loan and roll it into the dip. It's a 3-to-1 roll up. So that's for every dollar of new money you put in, you can take $3 of your term loan and move it into this higher class of debt. It also earns more fees and a higher interest rate as well as that. And it is a way for folks involved in the name to get potentially outsized economics. They got a specific allocation was held back for them of amount of dip that they could put new money in as well, which also because of the 3-to-1 roll-up gives them more that they're able to roll up. And that's to the detriment of other creditors who are getting to roll up less of their claim. And in a situation like this, it feels like if you're not in the dip, there's likely not going to be much value after the dip. So you want to roll up your claims as much as you can. So in this instance, $1.1 billion of new money comes in at the top of the stack ahead of the 1Ls, and $3.3 billion of the term loans are rolled into that. This got initial approval, but has not gotten final approval. I think that hearing is this week, and this is the hearing that, and this is what the SPV lenders are objecting to, because this will help in a lot of ways sort of set the stage for what they're going to be able to do going forward.
Is the roll-up of the first lien also going into the new company, or is that just a claim which is going to be of higher priority?
It's not any capital that's going in. It's just creating a claim of higher priority. So only $1.1 billion in new money comes in, but the new company will have $4.4 billion of this type of claim that is at the top of the stack, and that's why that's sort of a benefit that the creditors are getting for providing that dip.
Understood. I think it was described as non-pro rata. What does that mean, and why is it so controversial?
So one of the key concepts we deal with all the time is pro rata versus non-pro rata. So in a pro rata transaction, everyone who is of a similar situation, a similar base, owns a similar claim type of piece of paper, is treated equally. We're treated on a pro rata basis. We're treated equally. We all get the same. In this instance, this is non-pro rata in that there is a group that is providing the new money. The ad hoc group, they are opening it up to everybody. The $1.1 billion is open to everybody, but the economics are a bit different. There's, I think in the $1.1 billion, about 350 million of it is being held back for members of the ad hoc group. The ad hoc group is about 86% or was about 86%, I think, of the total amount held. Something on the order of that. That group, because of that $350 million holdback of the $1.1 billion, gets to put more new money in and therefore gets to roll up more of its loans into the dip, which is beneficial because those loans that are not rolled up have a much lower value. As well, we've reported that within that ad hoc group, there are different economics amongst members in there, with certain members getting basically a beneficial interest in the roll-up when comparing claims. So that $350 million holdback is not split evenly amongst members of the ad hoc group. In fact, when you're figuring out how much you're going to get, everyone's holdings are multiplied by a factor. Some of the holders get to multiply it by 100%. Some of the holders, I believe, get to multiply it only by 40% in terms of figuring out the allocation of that holdback. So if you are one of the preferred members there, you are getting a better slice, a better amount of the holdback. So you're going to have more new money, which we all think basically, and based on where it's trading and what everyone's talking about value, the assumption is that the new money is going to be money good. So it's trading through par, should get paid back. You get a nice amount of fees. There's a couple of different levels of fees that are there. But importantly, the amount of money that you put into the new money is reflected directly in how much you can roll up on a 3-to-1 basis. So if you put up more new money, allows you to take your old claims or your term loan claims, pre-petition term loan claims, and move them into this beneficial class of DIP claims, which are going to get better treatment definitionally than the treatment of the claims that are left in the old 1L. So you want to have as much of your claims rolled up into the DIP as you can, and as few as everybody else's claims as you can to benefit yourself. So that's what we mean when we refer to it as non-pro rata. Certain creditors under the term loan who had the term loan on the day it went into bankruptcy are doing better than other creditors who held the term loan on the day it went into bankruptcy. They are the same level of priority going in, but they're getting better economics on the way through the DIP, through this mechanism.
Would you say that the 3-to-1 roll-up ratio is overly aggressive?
I think historically where we've seen it, it's roughly in line with what we've seen recently. That number has grown over time, but I do think 3-to-1 seems to be kind of where the industry standard has settled. There is not a hard and fast rule in bankruptcy as to how much you can roll up. Like a lot of things in bankruptcy is a stakeholder, a court of stakeholders, a court of equity is not. So the judge is going to take into account what they believe is equitable based on their judgment. So there isn't, in this instance, a hard and fast rule. That said, you can't go in and say, well, we're going to provide $1 and roll up $1 billion. They're not going to let you do that. But usually somewhere around 3-to-1, we have seen that go by. Also going to depend on how forceful the argument is being made against it. Right now, I don't think we've seen any arguments against the roll-up itself. The arguments themselves are much more fundamental as to whether or not the DIP claims should get whether or not the SPV lenders are getting appropriate adequate protection, and whether the DIP claims should be able to get priority on the collateral that they're aiming to get priority on.
Were all creditors invited to participate, or was it an exclusive club?
For the DIP, all creditors that held the term loan were invited to participate. You just didn't get as good economics as everybody. Everyone got differing economics, but you were invited to participate, but your share of how much debt, new money you're going to be able to put in is related to, but not equivalent to, how much of the debt you held on the way in.
Do you think this unequal treatment of lenders will hold up in court, or is it another Serta Simmons style flashpoint in creditor-on-creditor violence?
I think in this instance, this is likely to hold up. I think they've got enough people lined up. As I said, the ad hoc group covered like more than 80%. Yeah. I don't know that any of the holdouts are going to argue against it that deeply. I haven't seen that yet. And to the extent that they do, we would have expected to hear it, and they may settle with them to give them a little bit more of the economics. But as yet, I don't recall seeing anything in that regard. So I would expect this to get this to be all right. And recall, this is in a post-bankruptcy context. This non-pro rata treatment is post-bankruptcy. So you would imagine once it's agreed to, once the judge approves it, that makes it kind of hard to argue against. It's going to be put into place.
The DIP credit agreement reportedly allowed factoring to continue, but if factoring banks had pulled their lines, could that have triggered a run on the company's working capital?
Yeah, I mean, certainly it could, sort of. It wouldn't be a run because those lenders are still stayed, because the current inventory lenders, or the inventory lenders for pre-petition, are stayed. There was that automatic stay upon the bankruptcy, so they can't do anything against the estate either. What it would create, though, is a situation, and we may be seeing some of this in the DIP budget. It's not entirely clear, but if you look at the DIP budget in terms of how much in sales they expect to produce, how much in proceeds they expect to produce, it is less than you would expect based on their level of sales. I want to say it's like $400 million versus annual sales of like $5.5 billion, let's call it. And I think that's a function of them dealing with within the bankruptcy, handling their business a little bit more appropriately across the entities. I think that's why it's bringing in so much less cash, and that's why the DIP budget shows them running out of money at the end of the year, because they're less reliant on this supply chain financing. So I think that's what's going on there, but it's a little bit hard to say looking from the outside looking in. Again, I'm not in the data rooms on that.
Understood. And the working capital financing is slowly unwound, so we see a gradual cash outflow over time.
Yeah, that would be the idea. But again, a lot of these working capital financiers are saying my collateral is gone. I've
Yeah.
heard that folks who thought they had billions in collateral, it's a couple hundred million. So
Okay.
we're seeing a couple of things going on. It does look like, and I would expect to see more on this going forward in sort of the near to medium term, as folks come in, as the professionals come in and are able to get a better handle on what's going on. I think you had a company that was being run by a very small group of folks led by Patrick James and his close associates who were not probably not very forthcoming with others at the company as to what was going on more holistically. So we've yet to really see a good 30,000 foot view. And here's what's going on at First Brands. Here's how it goes. There have been folks who've applied for an examiner. Some of the supply chain folks are asking for an examiner. That would certainly, to the extent, I hope they get it as someone looking from the outside looking in, because I think it would be very helpful to help understand what's going on in the bankruptcy. Whether or not they get it's a different story.
What is a normalized working capital situation for them, and what does it tell us for the ongoing cash need?
That's a very tough question to ask. So to answer, excuse me, it's an easy question to ask. That's a tough one because so we've looked at the company a bit, try to figure out these sorts of things. So you've got about a $5.5 billion in sales, give or take. If you need to finance that for a year to a year and a half, you're talking about taking 6, 7, 9, 8, 9% off the top on that. You also have inventory, several $1 billion of inventory that you're going to need to deal with, and you're going to need to finance. That's where we come into the question as to whether or not this is actually a broken business and can they survive at these, basic. It feels like at the margins they were actually earning, not what they were reporting, but they were actually earning. Obviously, it didn't work. That's why we find ourselves in bankruptcy. So there's going to have to be some push and pull here in terms of being able to get higher prices and maybe being able to pull in some of those terms at the same time as the company is likely to face higher financing charges as a company that's just exited bankruptcy. So, it really remains to be
Even
seen.
higher.
Yeah, even higher. And well, but they'll be on the books this time. They'll be on the
Yeah.
books. So, and there is an open question as to some of the rates we saw were IRRs and not headline rates.
Yeah.
An IRR can be a little bit hinky. Still, 30% IRR is a high rate. There's a high rate on there.
Yeah.
You're not doing that at 2%. So, so it does seem like there is this open question. I think the reported EBITDA, adjusted EBITDA, was 1.2 or 1.4, something like that. That feels very, very rich, very high, unlikely to be the case. We've put out some numbers where we think, broadly speaking, you could see a situation where they generate maybe $500 million in annual free cash flow, something along those lines, based on sort of historical margins. But from that, a lot of mouths are going to have to get fed. It does take into account some of the AR stuff. It doesn't take into account the inventory financing as much.
Understood. So when First Brands Group rolled up all these assets, they bought operating businesses with receivables and inventory, effectively with working capital in place. If they sell those businesses in a split today, the acquirer would get those businesses, but none of the liquidity. They would have to refund all those businesses by themselves. Wouldn't that funding need effectively come out of the estate's value and would depress recoveries further?
So it may. So one of the things I would highlight, though, is it does look like part of the First Brand strategy was to roll these companies up and then implement the supply chain financing that First Brands was using. It does not look like all the companies they bought were using it to the same level that they were. So that was part of the special sauce, so to say, that I think they were bringing to the table. If they were to sell these assets going forward, so if they were to sell them today, because it's post-bankruptcy, you would just sell the assets in a 363. You would not have any of the receivables that are coming due. Those had been financed out. You would have to start from a cold stop in terms of the sales that you made. You might have some receivables sort of post-petition that you would be buying, but any sales that you made, you'd have to finance sort of that year to year and a half to getting out there. But in terms of the inventory, you can imagine that those entities would be sold with the inventory, and then the fight becomes, how do we allocate that value that we received for the inventory across the creditor base? So you would need, and it will get worked into the price in terms of that long lead time. I'm going to go from now, I'm going to have this inventory, I'm going to sell it, but I'm not going to generate, I have to carry this business for a year till first dollars come in, unless I enter into an accounts receivable financing facility from this point forward at a rate that makes sense. So that's going to be incorporated into your valuation. You're going to have to figure, kneecap your margins by that amount that you're going to pay, because that's going to come off the top line. And then the inventory issue is going to come down to, that's going to be an issue for how those folks get paid after the sale, but is not a concern, would not be a concern of the purchaser, because they're buying it in bankruptcy, will have it free and clear, and it will come with some amount of inventory. How they choose to finance that transaction, that purchase, and their ultimate purchase price is a different question. And then the business going forward is going to require a lot of inventory at the same time as you're not getting any of those receivables in for that period. That's going to create a drag on what you can charge.
In any way, that sounds like a lot of fees for advisors and lawyers.
Oh, I think it's going to be hundreds of millions of fees in the advisors and lawyers. I think we highlighted in a piece that went out last week, there are 50 different law firms that have been hired. Not all of them have as high profile role as each other, but you've got debtors, you've got committees, you've got ABL, you've got the supply chain lenders. The supply chain lenders are arguing for a different bankruptcy of the SPVs. They want a trustee, they want an examiner. There's a lot of fights to be had and a lot of fees to be earned.
You've just mentioned it before, legal fees are exploding. Why are bankruptcies becoming so expensive?
Bankruptcy takes time. Bankruptcies take time, and everyone has to have lawyers, and lawyers' fees keep moving up, inflation, and there's time and money, and a lot of these bankruptcies now are about fights. There's been LMEs, there's been transactions that have been done beforehand that are creating a situation where there's going to be a long drawn-out process. A pre-pack is going to be much quicker. Obviously, that's when a company's going to file with the plan already in place, with agreement among its creditors. That's going to roll through. That's like 30, 60, 90 days. It's going to get done. But now we're seeing sort of the converse of that, the cases that are not able to do pre-packs. Those are your hairier situations. Those are the cases where you're going to have lots of fees. You're going to have lots of time that's going to be taken, and that's going to need to be done, and a lot of fights that we're going to need to have a decision on before we start to allocate value. I would also note that while bankruptcy is very expensive and it is very time consuming, it does have finality to it. You are able to do things within a bankruptcy that you cannot do anywhere else because of that automatic stay, because of the ability to negotiate or reject contracts, and to deal with your workers, to deal with your operations. It does give you a lot of power to change things, whereas a lot of the liability management exercises we spend all our time looking at really are just a solution for the capital structure, do not do anything for the business itself. And a lot of these companies that are doing these have fundamental problems at the business level, which are not dealt with through the liability management exercise. Hence, they'll have to do another one, or maybe do one and then go into bankruptcy. Again, the liability management exercise is really putting into place the priority scheme for the following bankruptcy, the ensuing bankruptcy. That's the goal of it. And that's also going to create some of the expense associated with it, because you're going to bring those fights into the bankruptcy court.
Understood. For investors, how do you even think about recovery here when EBITDA itself may have been inflated by financing mechanics?
Yeah, I think you got to hang your hat on what we know and maybe what we trust. And in my case, that would be something like revenue. If you assume $5.5 billion in revenue is about right, and if you look at some of the public filers in terms of what their payables look like, you can see your way clear to that number. It does sort of make sense. It fits in. I don't think anyone said, no, that's way too large. They weren't doing that. And then from there, it's about thinking about, again, what kind of cash flow margin can you generate from that, from just that pile of businesses. And it's hard to say where that number shakes out. I think it's easier to say where that number is unlikely to go. It feels like $1.5 billion isn't right as a cash flow number. That seems rather aggressive at 30%. So something in the, 8, 10, 12% range feels about right. And then from there, you got to figure out how are you breaking that up? How are you breaking that up amongst your different financial parties? There's going to be lenders into it. There's going to be equity into it, but there's also going to be this inventory that you're going to have to finance. Maybe you don't need to do it as much as you did coming out of the bankruptcy because now you own that free and clear. And so you're able to manage it in a better way. You're not looking to do the roll-up strategy anymore. You're not looking to generate capital in that way. Maybe you don't need all of that supply chain financing there. That may be the case, and then you're generating, some amount of cash flow that can be shared with all of the stakeholders who are just your lenders, and then your equity. That may be the way they ultimately go. But then, in terms of thinking about recovery for various pieces of the debt stack going in, the pre-petition debt stack, you have to account for what are the supply chain lenders going to get. They lent money in; they have to get something. When I say that, I don't mean it has to be a dollar amount. It could be zero. But there is going to have to be a plan put in place and agreed to by a judge and voted on where they're going to get some recovery based on their claims. They have legitimate claims into the SPV debtors. There have not been allegations that those claims are not legitimate. They're just concerns about the collateral and the double pledging and how that works. So there is but one set of assets to pay everybody off with, and that's the businesses. How that gets split up, that's the open question. That's the $64,000 question in terms of where this bankruptcy goes.
Could off-balance sheet vehicles like the SPVs end up being separate collateral pools, or will courts likely drag them into the estate?
Yeah, I mean, so generally speaking, SPVs, bankruptcy remote SPVs, we've seen a number of them kind of get pulled into the bankruptcy. It's usually consensual. I'm thinking Hooters of America, TGI Fridays as well, had a couple of bankruptcy remote SPVs that were brought into the bankruptcy to be dealt with. In this instance, these SPV entities are already bankrupt. They have filed. They are in bankruptcy. They're not. I think there's maybe a move by one of the creditors to try to get them out, but I think that's more a negotiating tactic than anything else. So they're in bankruptcy. The question is going to be whether they're in the first brand's bankruptcy that covers all of it, or they're two separate bankruptcies that run alongside one another, but have different debtors, different debtor representatives. The SPV lenders are suggesting that they don't want the management of first brands to be the manager of the SPVs. They think there's too much of a fight between those two entities to have that be the case. We're waiting to see which way the court's going to go on that. But they are certainly in bankruptcy now, and there's no indication, no expectation they will not still be in bankruptcy, the SPVs. That is going to be the process. The bankruptcy court does provide the best way for them to get what they're after, their lenders and their claimants to get what they're after.
You've seen a lot of bankruptcies in general. I mean, you're a bankruptcy expert. What parts of the capital structure or claim spectrum tend to offer opportunity in cases like this?
So in a case like this, I'm surprised we haven't yet seen the supply chain lenders ad hoc group together. And I imagine that may come in the future. But I would imagine there are some folks who are looking at those claims, trying to see if there's anything there, if it's worth the fight. Right now, based on where things are trading, you've got this $1.1 billion new money dip. You've got the roll-up dip behind it that's trading, I think sub 50 cents. Seems to be the fulcrum security in the ultimate company. I do think there's a risk that seems not to take into account risks associated with the SPV being dragged along. There are, I used to do trade claims, so there are certainly critical vendor claims that are going to get paid, maritime lien claims that are going to get paid. Those claims are likely to get paid in the next number of months, so they may not be availability there. I think your unsecured claimants are likely to be somewhat out of luck. I don't think there's that much value that's there for them. There is the potential there's some recovery there, a stub recovery on some of those claims. Now, a lot of those may be held by financiers. It remains to be seen how those vendor financing, the reverse factoring works for those suppliers who are owed money. It may be the folks who provided them the financing that are owed that money. I don't know that we've seen them file yet any claims or anything like that.
Out of the working capital financing silos, are there any unsecured, or, I mean, the usual assumption is that all of them are secured financing?
Yeah, well, I mean, they're certainly undersecured. So we've certainly seen allegations of that, and that makes sense that they don't have the security they thought they had. Whether or not they get treated as unsecured, that is a different question, because they would argue that the fraud was committed upon them. They should be treated similar to everybody else. The fraud was committed on all of us. I would imagine that's the argument they would make. That's the argument I would make in their shoes if I sat in their shoes. We were all defrauded. You can't say, oh, the first brand's part of the half of the house is fine. It's the SPVs that are committing the fraud. I think that's an argument I would make as a holder there. But so they're certainly undersecured. How those claims get treated, it remains to be seen. That said, I don't think there are other claims at those entities other than the supply chain financiers. I think any other unsecured claims would be at the first brand side. We haven't seen schedules yet, so we don't know that for sure, but that would be my guess.
What would happen if, like the ABL facility and the SPVs with inventory financing have been commingled?
Yeah, and I think that's one of the allegations in the double pledging. There are situations where inventory was moved into first brands and maybe became collateral of the ABL. That's gonna be for smarter folks than I to disentangle. To see, it's going to come down to whether or not they can, in fact, disentangle it, and then they're going to have to argue in front of the judge how they think it should be handled and who was defrauded and how we're going to treat them. I think again that's going to be that's sort of the key fight. The ABL, as I said, has a first on ABL collateral, which tends to be inventory and accounts receivable. The term loan has a second on that collateral, so they are also involved in this, because to the extent that there's any collateral. And to the extent the ABL is oversecured, that collateral value would flow to the term loan, although the SPV lenders are certainly going to see it a different way, I would imagine. So that's going to be that's the open question, is how do the ABL term lenders on one side and the SPV lenders on the other, who may believe they have claims on the same assets, how do they resolve that? And there's no particularly hard and fast rules about that.
If we think about an extreme scenario where all of the assets in the inventory SPV was moved toward or was used in the ABL facility, what would happen in such a scenario?
You could see, one of the things you could see is a substantive consolidation of the entities, where, and I'm not suggesting this is going to happen, we don't know yet, but in a situation such as you posit, where there was clear all the value moved out of the SPVs to the benefit of the ABLs, you could see an argument being made that this isn't 50 different entities, this is a single entity, and we're going to handle all of you similarly. So everyone is going to get the same thing. So the SPV lenders and the ABL lenders, the term lenders, are all of the similar priority because you were all defrauded. Again, substantive consolidation is not a remedy that's used lightly. It doesn't happen that often, but in massive fraud cases, it is often the case where that's done, because the argument is that there is no corporate veil. There are no different entities here. They're actually all alter egos of the person who was committing the fraud, just different ways of doing it. And so one group of creditors should not benefit at the cost of another group of creditors.
Could trade claims or DIP participations be interesting plays here?
Well, certainly the DIP is a fulcrum security because of where the roll-up is trading at a sub 50 level. That is the fulcrum security right now. So if you have a sense of where you want to basically create first brands on the way out, the DIP is the way to play it. The DIP roll-up is the way to play it because that's the fulcrum security right now. The DIP stub does have the 1L stub does have a little bit of value, but it feels like the convexity is enough on the DIP roll-up that you don't need to look there. In terms of trade claims, we don't know enough right now about all of the debt at all of the entities and how that was done. I would imagine the 1Ls are at each and every subsidiary, so there's unlikely to be much value that could flow to trade. Conceivably, there may be value associated with contracts and contract rejection claims, and to the extent those contracts need to be assumed, those rejection claims need to be made whole. You could look there for that. It's still very early days as far as that goes, as they haven't rejected any contracts. They haven't really done anything. Trade was used to getting paid at very extended terms. So now they're 30 days late. It's not clear how it's worked through the process. Certainly the financiers who are owed that money are tracking it, but whether or not there's anything there or what they're doing yet, we haven't seen anything.
who are the likely winners and losers from the first brand situation?
So, I mean, I think the losers are going to be the folks who, the par money lenders who are lending money into the structure. Obviously, the most of them are probably out now, but really took it on the chin there. The inventory financiers, the SPV financiers, they're not getting 100 cents. That just doesn't. There's just not enough value for that. So that's going to be a real risk, or someone who's going to lose. Probably the winners are going to be those folks or those investors who got in when the debt had traded down to the 30s, that bounced off the 30s, and then were able to coordinate and put the dip together, get themselves on the right side of the economics of the ad hoc group to take outsized economics on the roll up. My guess is they'll do all right.
Beyond First Brands itself, I think this case raises bigger questions about how credit is being underwritten and priced today. Jared, do you think that First Brands is just a one-off case or part of a broader pattern we are seeing in credit alongside Tricolor, Western Alliance, and others?
Yeah. So, and we've seen a couple of other ones actually over the last couple of days that have come out in the news. It's a little hard to tell. I think there's some telecom company out of Long Island, Broadcom. It's not Broadcom. It's something similar. Where HPS had some loans into there, and apparently were based on accounts receivable that may not exist, invoices that don't exist. Certainly at a time when you see First Brands and Tricolor, you're going to see more of these being announced and re-reported as people are going back and redoing the due diligence work that they likely should have done on the way in. We're going to see, I would imagine we're going to see more of these kind of coming out. So you mentioned Tricolor, which also has securitizations, which there have been claims there have been double pledging of car loans or installment contracts under multiple securitizations. That's at Chapter 7. So that's a mess. They were servicing their own loans, and their financiers were allowing that to happen. We've seen a couple of other cases similar. There's a Compass Diversified has an entity called Lugano that it bought in, a jewelry company that is they can't close their books because there's something going on over there. I think the gentleman who ran that has been accused of a Ponzi scheme. The stuff with Western Alliance Bank and Zions Bank and some of the bankrupt entities, I think it was the California entities, MOM, California entities, the folks who were taking out loans that were illegitimate or fraudulent. So we are certainly seeing more of that. And we're in the Josh Wander 777 case, we are seeing more of that now. That's a function, I think, of what's happened so far, that we're seeing Tricolor and First Brand, so people are looking more closely. I do think it's also a sign of where we may be in this economic cycle. Excuse me. There's a great concept that I really like. John Kenneth Galbraith came up with called the bezel. And that's the period of time between when a mark is taken for his or her money and they realize it. And it doesn't necessarily involve fraud, but frequently does. And the idea is that there is a little bit of an economic signal within this, that in times of economic plenty, this period of time is quite long, while people are not as concerned with things. Whereas as the economy turns or there's stressors, that time tends to shorten, and people are more aggressive in their due diligence, and that's what we're seeing now. I would highlight there is a knock-on economic impact to this potentially in that in the period of time of the bezel, and this is the point Galbraith is trying to make, there may be excess economic growth as two parties believe they're sharing the same wealth. They don't realize it, but they have the same wealth. So that, I always think of the Madoff creditors who prior to the frog marching in December of 2008 thought they had $60 billion in assets at Madoff and were spending like they had $16 billion in assets at Madoff, whereas Madoff had been spending his $17.5 billion down to $1.5 billion, and that had created a whole lot of economic activity. When that comes to an end, you have a dual impact. You're coming off a sugar high, and at the same time as a bunch of folks who thought they had $65 billion in assets no longer have realize they no longer have $65 billion in assets. So there's a knock-on impact there as things may slow down. So I do think there's the chance that why we're seeing more of these now is the stress under the economy with tariffs. As well as these things keep propping up, we are likely to see more of them, and I think it's a sign of where we may be in the credit cycle in terms of, and the economic cycle, things getting a little bit long in the tooth and maybe about to take a turn. I will say I'm a distressed credit analyst. I've been doing distress for a very long period of time. I tend to see distress everywhere, so it's a part of the it's a part of the job. But it is certainly interesting how many we've seen and how many stories we've seen over the last several weeks, just in situations that do have sort of this component to it of a lack of due diligence.
Do you think we are seeing the return of Greensill style risks where supply chain finance becomes a form of shadow leverage?
Yeah, I mean, Greensill wasn't that many years ago. It wasn't that long ago that this happened, and now we're seeing it sort of happen again. Look, capital like water raises to its own level. Everyone's trying to put money to work in interesting ways and make nice returns. And that supply chain financing turns out to be a great way to make these returns. If you don't ask too many questions, you can make very high returns. And it turns out that becomes an area rife for situations like Greensill or like First Brands, because it is off market, it is off balance sheet. Not everybody is looking for it. And so you have these situations where the money is good and it's good for a while. Look, it's like a Ponzi in that way. The key to the Ponzi scheme was the first, Charles Ponzi was able to pay off his debtors, his lenders the first time around. These folks who have been providing supply chain financing for First Brands were making money over the last several years under these programs. They were doing quite well. Now it all blew up on them, but for that, and until that point, those were successful programs. So capital is going to rise to its own level, and there are going to be all these people out there trying to put money to work at different rates. So it's just surprising we've had another one of these so close to Greensill. It's slightly different. It's certainly different, although we don't know the full extent of First Brand, so we don't know how different it is.
What do you think is the key takeaway for investors in complex credit situations like First Brands?
I think you got to understand what's going on, do your due diligence, look through everything. If something appears too good to be true, it probably is, and just make sure it all makes sense and holds together, and go through the numbers. I haven't seen the cash flow statements from First Brand, so I don't know how it's all reflected in there, but it should all be in there. Cash is king. So you should be able to tease that out. And to the extent you can't, and it becomes too opaque, I mean, that raises all kinds of questions. You need to understand how it is. I think the most important thing about understanding a company is, how do they make money? How do they actually make money? Not what do they tell you they do? How do they actually make money? How are they generating money? And so I think that's, in doing your due diligence and doing the work involved in that.
But in this case, are we just doing less diligence as a market, or is it just getting much more complex than ever before?
So I think it's certainly getting more complex than ever before. As I said, I haven't seen the financials, but I would imagine these costs were somewhere in the financials. And I would imagine as well, when you look at adjusted EBITDA versus EBITDA, those adjustments are going to be quite large. One thing we didn't touch on as a roll-up, there may have been some odd accounting as well in terms of marking inventory up on the purchases, in which case margins would have been compressed. It may have been compressed as they bought new things in. That may have made it difficult to analyze as well. But it's really about getting a good fulsome understanding of what the three statements are telling you and what the cash flow is telling you. Why is it, they were continually in the market to raise money. They were doing the roll-up strategy, but making sure it all holds together.
There's one winner in all this. Bloomberg reported that Apollo managed to short the First Brand loans. That's pretty rare. How can you even short a loan?
Well, yes, that is very rare. We have some theories on that. We don't have any particular insight into it, although I do think if you're Apollo brokers, your prime broker will work with you in a lot of ways to try to create a situation where you can take advantage of what you see as a mispricing in the market. But we don't have a great sense as to how they were able to short something, which we understand the borrower was very difficult on, whether it was through failure to deliver or something along those lines. But the reporting is that they were able to take advantage of the situation. And I think, gun to my head, I think what likely happened is Apollo saw was able to see different financings opportunities at First Brands and put 2 and 2 together at a very high level in the company, where someone said, oh, we're seeing this on the supply chain side, we're seeing this on the term loan side, we're seeing this on the AR side. This doesn't match. There's something that's off here, and that may be what highlighted the problem to them about the business. I think they also have a company called Tenneco in their portfolio that is in a similar business to First Brands.
Would you say that this shift creates a permanent advantage for a larger platform like Ares or Apollo, who have like private equity arms and private credit arms, or is it more advantage to like smaller and more nimble players?
So there's certainly advantages to both. I think the ability to be nimble is certainly that was shown here. Where the bonds, the term loans, went from like 95 to 30 in the space of a couple of days. Although we did hear some of the desks were moving close to $1 billion in paper. So I do think that, I think the larger shops are certainly going to see more opportunities and different opportunities that may not be available to the smaller player. But the smaller player is also going to be able to get involved in situations that won't fit the larger companies like an Apollo or an Ares, just because they can't put enough money to work to make it matter. They need to put hundreds of millions, if not billions of dollars to work in each individual situation. Otherwise, it really, they put $50 million to work and it quadruples. It doesn't really do very much for them. Whereas for a smaller fund, obviously, or a smaller investor, that's going to have much bigger impact.
Jared, this has been fascinating. If you had to distill one lesson for investors or analysts from this case, what would it be?
I think the lesson is you've got to do your homework. Investors need to understand what a company is, how it works, how it makes money, and they need to do that work themselves and really do a deep dive into sort of the inner workings of it, understand the cash flow statement and how the company is generating cash, and not outsource that sort of work to the market and say, oh, well, it's trading at this level. It's, these things trade at 7 times EBITDA or something like that. So I'm going to put my money to work at, S plus 450. So I really think it's important that you do your diligence on these names and understand how they work.
Jared, thanks for joining. Where can listeners find more about your work at Octus?
Joseph, thanks for having me. This was great. So on Octus, they can certainly search for my name to find my work as well. Any of the pieces that I put out on First Brands or other names have a link to my email. Always happy to hear from clients and subscribers to talk about all these situations. So that's how they can certainly reach out. They can also reach out to their client success manager if they'd love to talk. I'm happy to, as I said, always happy to hear new things and see what people are working on.
Thank you for listening to Fixed and Floating, the credit podcast. If you enjoyed this episode, please follow or subscribe wherever you get your podcasts.